Bitcoin keeps bleeding, but is this the moment it bounces back, or is it the start of something deeper? In just 2 days, we know $2.75 billion in longs were liquidated, which makes these now two of the year's three biggest wipeouts. The Fear and Greed Index has also collapsed to 28, levels seen only during the pandemic events such as the COVID crash. Bitcoin is now testing its summer lows near 109,000, right on the 21-week EMA, which, if you don't know, is the line that has defined bull market support for years. So that's our battlefield. And while retail traders are capitulating, whales, those who know, are stepping in. We've seen Wintermute moved hundreds of millions of dollars in stablecoins to Binance. And one whale in particular scooped up $55 million in Bitcoin. And just hours ago, another dropped $247 million in a single buy. Now that's what real positioning looks like. That's what real know-how looks like. And we know that every cycle has its retest. The flush that clears leverage shakes out retail and hands coins into stronger hands. So the question is, are we watching? Okay, are we observing Bitcoin's breakdown, which I don't believe? Or is this the reset that lights the fuse for the biggest rally of Q4? So if you want to know what's coming next, stay tuned. That is what we're getting into in today's video. All right, so zooming out, the macro picture is very noisy, needless to say, but the tide is shifting. On Polymarket, odds of a Fed cut in October slipped, while the chance of no change climbed to 18%. Traders see hesitation, that's what this means. But the last time the Fed cut rates in 2024, Bitcoin dropped 12%, and then it rallied nearly 60%. So it's the same setup, just a different year. And politics, if we take a look at what's going on there, it has also added fuel. Trump blasted Powell for incompetence, he said, and unveiled the largest tariff wave in months. 100% on pharmaceuticals, 50% on cabinets and vanities, 30% on furniture, and 25% on heavy trucks. US tariff rates are now at an 80-year high, which is inflationary pressure stacked on top of a fragile cycle. And fresh inflation data confirms the pressure too. August PCE inflation, which is one of the Fed's preferred gauges or metrics, rose to 2.7% in line with expectations, while core PCE came in at 2.9%. That's the highest reading since February this year. And yet, the Fed continues to cut rates. Meanwhile, the money supply is quietly surging. M2 has grown for 18 straight months, reaching a record $22.2 trillion in August. And inflation-adjusted M2 has been positive for a full year. Liquidity is building again. And stocks reflect this too. The S&P 500 has been green for 5 straight months. And historically, when this happens, November has never been red, has never been a down month. And the global risk cycle charts say this is the early stage of risk on, not the late stage. So the setup is aligning, is what it tells us. And it tells us it's not over yet for Bitcoin in the crypto market. It's just getting set up. Now let's get into the technicals and patterns and what they inform us of. We see that Bitcoin has already slipped below the $112,000 level, which had been the short-term line for the bulls. Okay. And now it's pressing against the summer lows around 109,000, sitting on the 21-week EMA, which is the same zone that has defined a bull market support for years. And if this area holds, it could mark the cycle's reset. But if it breaks, on the other hand, the next major confluence is down near 105,000, where the daily 200 moving average, the 200 exponential moving average, and the 0.382 Fibonacci retracement all converge. And to understand why this zone matters, the 200-day moving average tracks Bitcoin's long-term trend. The exponential version reacts faster to recent moves, and the Fibonacci level highlights a common pullback zone. Together, they form reinforced support, exactly the kind of level big buyers watch. Bob Lucas says Bitcoin is forming its weekly cycle low, and a move back above $118,000 would confirm a new cycle. Bitcoin dominance is also regaining its long-term channel, holding above 62%. So this shows relative strength even as altcoins are struggling. And let's take a look at the order flow. After the liquidation cascade, spot premium surged to its highest since June, when Bitcoin bottomed at 98,000 during the whole US-Iran conflict, when leverage was flushed and spot buyers stepped in. We're even seeing a double retest on support, the same setup that played out in August of 2023, right before Bitcoin rallied. And the Fed cut fractal, and this looks like the textbook reset before a Q4 acceleration. Now let's take a look at what's going on with Ethereum. Ethereum is flashing one of its rarest signals ever. Its 4-hour RSI, the Relative Strength Index, which is a momentum indicator that tracks when an asset is overbought or oversold. It just dropped under 15%. That's only the 19th time it's happened in the past decade. Ethereum is now the most oversold since the April crash, and some analysts say that points to a sub 4K risk. $4,000 risk. But the flows, they tell a different story. In just 2 days, 15 wallets accumulated 406,000 Ethereum, about $1.6 billion worth, and all directly from exchanges and custodians like Kraken, Galaxy, and BitGo. ETFs now hold 6.76 million Ethereum, roughly 5.6% of supply. And those ETF numbers are only one piece of the institutional puzzle. BitMine, one of the largest public treasury companies allocating into Ethereum, amassed more than 10 billion in Ethereum holdings in just 71 days. And on top of that, the US ETH and staking ETF launched this week, giving institutions regulated yield exposure. And here's what's very interesting. Open interest just saw its biggest reset since 2024. Leverage has been cleared, and whales and ETFs are filling the gap. That's how you set up a supply squeeze. Short-term paying, long-term flows building. Now let's talk about stablecoins and the next super cycle. Everyone's watching ETFs lately, but the real long-term driver is stablecoins. Cloudflare just launched Net Dollar, a dollar-backed coin designed for instant secure payments on the agentic web. That move, shows how even tech giants are entering into the stablecoin race. And they're not alone. In Europe, 9 major banks are preparing to roll out a MiCA-compliant Euro stablecoin in 2026. And the thesis is very simple. By 2030, trillions of dollars will be moving on-chain through stablecoins. Once companies realize they can transfer dollars instantly, payrolls, vendor payments, and treasury operations will shift to crypto rails. And once those dollars are there, they'll seek yield in Aave, Morpho, or other reputable vaults, driving total value locked to new highs. And the impact will not stop with financial flows. As soon as companies start running payroll and payments on chain, the software they use, think about it, to manage those dollars will have to change as well. Total enterprise systems like accounting, treasury, and CRM were built for data that updates monthly or quarterly, while on-chain money moves in real time, refreshing every 12 seconds. So that mismatch will disrupt the entire stack. Stablecoins, in many ways, are the Trojan horse. They're leading the way, pulling real economic activity on-chain and forcing business infrastructure to adapt to Web3. our world, making DeFi become the backbone of global money movement. However, while stablecoins may be reshaping the way money transacts and moves, they're only part of the picture. At the same time, the world's largest institutions and governments are taking concrete steps to secure their place in this new system. Morgan Stanley is preparing to roll out a crypto asset allocation strategy for client portfolios. And Kraken just raised $500 million at a $15 billion valuation to fund its expansion and IPO plans for 2026 next year. And we see Vanguard, even the $10 trillion mutual fund giant that has avoided crypto for years, is now preparing to offer crypto ETFs on its brokerage platform. And Nubank, a $76 billion fintech powerhouse in Brazil with 114 million users, says it wants to lead in the Bitcoin industry. And Canary Capital has filed for a Solana ETF that would hold and stake Solana. Multiple states are stepping in as well. For instance, Ohio will officially begin accepting Bitcoin for taxes and fees. Meanwhile, regulators are circling. The SEC and FINRA have contracted more than 200 digital asset treasuries over insider trading concerns. And the SEC has met with VanEck to discuss ETFs, staking, DeFi, and custody rules. Even as oversight expands, the adoption base keeps growing across Wall Street, global fintech, and state companies. The pipes are being laid everywhere, every day. That's why, if even from this fundamental standpoint, the bull run is so not over, guys. It is just getting started. As we close out today's video, we have seen that over the past week, the market has gone through a full reset. Leverage has been flushed, sentiment completely crushed and questioned and shaken to its core, and prices pressed back to key support levels. But beneath all of this noise and superficial drama, whales are buying, institutions are filing, and stablecoins are laying the foundation for the next phase of growth. Capitulation always feels like the end, but more often it's the point where the base for the next rally is quietly being built. The new support level, the foundation. And this is how bull markets breathe. I always say it, the market has to breathe, right? In, out, up, down. It's very normal. And if the patterns, flows, and history all align, the fear we're seeing now may be the spark that drives acceleration into Q4 and beyond. Anyway, guys, that's a wrap for today's video. I love you guys so much. Take care. Enjoy your weekend. Make sure no matter what, go outside, you spend time with friends or family, or you watch something funny. Your brain needs to laugh. You need to rest well. You need to think about your plans for your future, how much you're going to allocate. Take a look at your portfolio or shut it away altogether if you've been staring at it too much. I know for me, I don't panic during these times because I know where I'm positioned and I'm at peace with that. And I see everything going on in retail, in the charts, in the regulatory economic scene of things. I see it as the weather. It doesn't shake my investments. So for me, I will take the weekend sometimes just to reevaluate, take a look at how I'm doing, just so I know exactly where I'm at. But if you've been staring too much at your wallet and your portfolios, then maybe take a step away. Anyway, I love you and I'll catch you guys here on Monday.